Live from New York City for our audience worldwide, Bloomberg Real Yield starts right now. Coming up, investors grappling with stagflation risk, central banks hiking into the threat of weakness, delivering a week filled with volatility. We begin with the big issue, a messy market.
Volatility markets are incredibly high.
Volatility in the bond market has been going up.
The reality is there's very little risk appetite.
People are negative.
It is a big struggle for investors.
And it's all part of the same story.
The mess we're seeing in the market is about liquidity.
The Fed is going to hike rates like crazy.
We're tightening financial conditions.
Financial conditions are tightening really abruptly.
We haven't priced liquidity risk. We haven't priced credit risk.
Higher rates, higher spreads, higher mortgage rates, higher borrowing costs.
You got to be patient.
People just want to play defense right here.
I mean, these are incredible levels of vol.
There is no safe haven in this marketplace.
We're holding our cash with both hands.
Joining us now to discuss, SocGen Subadra Rajappa, Nuveen's Tony Rodriguez and George Goncalves of MUFG. Subadra, first to you. Let's just reflect on the volatility this week in both equities and bonds. And I'm laughing because I'm looking at the Nasdaq 100, which is flat on the week. The S&P 500 flat on the week. It has not felt like that kind of week. Subadra, your reflections, your reaction to this week.
Well, the roller coaster is definitely giving me motion sickness. I can't seem to keep the directionality on rates or equities or vol straight. And like your introduction was saying, I mean, it's a combination of many factors. It's not just one thing. It's high volatility, tighter financial conditions. Every component of the financial conditions index is showing a decent amount of tightening. It's higher interest rates. It's higher real yields. So it's it's across the board. It's really hard to get a handle on what exactly is going on. I think that the Bank of England was, the first central bank to acknowledge that they might be heading into a stagflationary environment. And the question for the U.S. and Europe is, are we headed the same way?
Tony, your take on the last 5 days?
Sure. Well, Jonathan, as you mentioned, week on week, it's flat. So I think in 22, flat is the new up. The volatility is clearly extraordinarily high right now. Liquidity is certainly declining. And I think all of that really comes down to the fact that we're maybe close to peak uncertainty around what the economic data is going to be telling us, particularly, obviously, on the inflation front, and uncertainty around what policymakers are going to do in response. We found out that they won't do 75, but right now the market's pricing in 2 or 3 more 50s, but we really don't know coming out of the summer whether the Fed's going to be dialing back to 25 or continuing on this path where 50 is the new 25.
George, your thoughts?
Look, I agree with everything Subadra said and Tony, but I think we also have to remember that many of us have not seen this sort of volatility before, and the markets are changing. I think it's just really the repricing of liquidity, the financial conditions tightening that was mentioned, and really having to know how to set up your trades here. It's a different market, and the Fed's really not blinking yet.
It's a new regime, and you don't think the Fed's blinking. When you say the Fed's not blinking, what would make them blink?
I think really it comes down to the credit markets. If we get really an impairment in the credit channel, which hasn't really happened yet, and of course even more drastic tightening of financial conditions, this is really the beginning for me.
There are some people that think this week the Fed made a mistake. George, take a listen to what Mohamed Al-Arian had to say a little bit earlier on.
I worry that the Federal Reserve has tried to be too nice to markets, be it the transitory inflation narrative that lasted way too long, be it what happened on Wednesday. You cannot come on TV and speak about all the uncertainties and then rule out a certain policy response, 75 basis points.
Mohamed said it. The market sees through it quite quickly. Evercore went even further. They said this earlier on this morning. Powell's mistake was to strike a tone that prematurely invited the easing of financial conditions. They went on to say, the market's mistake to rally hard without sufficient new information to warrant this in conditions in which such a rally could not possibly be sustained. Subadra, do you think that Chairman Powell, this Federal Reserve, made a little bit of a mistake with policy communication this week?
Not really. I mean, if you look at the division among the Bank of England, and I go back to the Bank of England because I think that their meeting was actually quite interesting to me. there is really a range of opinions among the MPC on what the right policy prescription is going forward. And that's exactly the debate I'm sure the Fed is having, even though the vote to raise rates by 50 basis points was unanimous, and we didn't really get any dissents from people like Bullitt. So I think that the policy prescriptions are very, very tricky. In the U.S., the economy is fundamentally strong. I think raising rates by 75 basis points would be some sort of an admission from the Fed that they have actually committed a policy mistake and that they should have raised rates a lot sooner. So a more gradual 50 basis points at the next several meetings could accomplish the same as raising rates by 75 basis points at any given meeting, and that's still an option for them. So I don't see anything that came out of the Powell, press conference as being, a misstep.
Tony, your thoughts?
So I would define a Fed policy mistake as having been what occurred in the fall. They clearly missed how aggressively they would have to respond to inflation. They were missing kind of all the signs of how much it was accelerating. What happened with the meeting, I would argue, is really probably more a mistake by the market in its interpretation of the Fed. It was a little confusing, I think, that we saw that big rally following the press conference. Obviously, the reversal was incredibly aggressive, but I would say that the mistake was in the fall. They are still digging out from that, so their credibility, they're trying to earn back from the market. And that's crashing into the fact that there's a tremendous amount of uncertainty, so that all forecasters are all over the place with respect to what they think the Fed will be doing as we get towards the fourth quarter of this year.
George?
Look, I'm much more with Mohamed El-Arian. I do think that they did miss an opportunity. Like at this point, front loading and being tough is how you fight inflation. And they kind of fell back into their comfort zone. 50 bips is nothing to kind of, to frown upon. And I think that they're going to deliver multiple ones as well. But just really taking 75 off, that was not necessary. And and Powell's still trying to thread the needle where Subadra brings up the Bank of England, but I would argue the Bank of England is way much more transparent, and they're actually realizing that there is a risk of recession, and the Fed is really still trying to lean on the strong economy. A lot of these indicators are forward-looking. If the Fed's behind the curve, they have to hit it hard, and if they don't, they have the risk of either falling into stagflation or the recession. It's really suboptimal choices, but being realistic with the markets, I think, is probably the best way at this point.
George, does some of what you said explain what's happening further down the curve on 10s? The fact that we keep breaking out, yields higher.
Yeah, look, the market is calling the Fed out by saying, if you hold off on hiking, we're going to reintroduce more term premium out the curve. So you kind of have to pick your spots. When the Fed wants to use the front end and raising rates as their primary channel, then they better hit it hard. And then I think that's really what the break-even curve, trying to do that a little bit, real rates rising up, overall risk premiums are getting reintroduced into the market, no less. But if the curve steepens here more, I think they have an issue.
This is where I've struggled, Subadra, and you haven't. So help me out here. The front end, fairly straightforward. The Fed's building out rate hikes. I've got all of that. We've had a big move year today. The longer end, this is where things got confusing for me going into April, coming into May. I think a lot of people got comfortable with this idea of a flatter curve, perhaps even an inverted curve. As we start to go into growth risk, yields at the long end would be more capped as the Federal Reserve gets a little bit more aggressive. That hasn't happened. You've had a target on a 10-year bund of 125, on a 10-year Treasury of 325. Subadra, can you help us understand what you've used to help you understand where the long end's going?
So that's a very interesting question. I think that we're pretty much on the flattener camp as well. The curve had gotten way too flat, so you're seeing a little bit of a respite here and a steepening of the curve. Like you mentioned, the front end is very much pegged to Fed expectations, so there's not that much room for front end yields to move unless the Fed pricing of hikes changes. But at the back end is much more dependent on what happens to global bond yields, and that's when you're seeing bond yields are starting to rise quite meaningfully. They're getting close to our 125 target for this year, and JGBs as well. You're starting to see that global bond yields in general are starting to fight their respective central banks and starting to push higher. When bond yields start to move higher, then you tend to see Treasury yields start to move higher in the back end as well.
Tony, do you agree with that?
I do agree with that largely. I also think that, though, when you're looking at the back end of the curve and you're talking about financial conditions, when you look at the mortgage market where we're seeing an increase of well over 200 basis points in mortgage rates, I think you're going to see a more significant impact on the housing market from that as we move into the third quarter and the fourth quarter of this year. So financial conditions, when related to the long end, have gotten pretty tight, which I do think will ultimately put a little bit of a lid on how high we can go from here on the 10-year. Our call would be that we will end the year pretty close to these levels. We may see higher levels over the next couple of months, but ultimately I think that would reverse back into a flatter curve and one that recognizes the financial conditions have gotten awfully tight relative to where long rates are in the housing market.
George, when it comes to this topic, where are you now?
Look, I think we're in the process of trying to topping out. I mean, 325 was the former high that we saw back in 2018. We've seen lower highs each cycle, at least for long-term intermediate rates. It's possible we go above 325, much more than that. I think that we have a bigger problem on our hands. And I do agree with Subadra that the global rate story is probably driving it. But at some point, it gets to a point where it's going to really hurt. Tony's right on the housing sector. I just feel like there's going to be a point where financial conditions, the real rate move, the risk introduced into rates is basically the 8th or 9th inning in my view. It's only catching up to equities and credit. And I think once they really finally go, then we'll have a rally back in the long end.
George, you really think the damage is done here, that we've already made that move? I know you think there's more damage to come in credit and equities, but ultimately it's done. What I hear from you is that this is a hard landing, it's coming, it's just a matter of time. Is that right?
I think that's right. I mean, I think the only way that stops is if the Fed blinks in the middle of the summer, and they're only going to blink if the credit market gets hurt or credit gets impaired, and we get, just in general, a view that the economy is decelerating and have, inflation start to turn over. Until then, the Fed's going to keep going until they break something.
We'll talk about that next. Subadra, Rajappa, Tony Rodriguez, George Goncalves sticking with us. Coming up next, the auction block. Junk bond issuers going completely silent for the first time in months. That conversation next. Live from New York City, I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the auction block, where we kick things off over in Europe with one of the slowest weeks of the year, with volume falling well short of estimates. Morgan Stanley's two-part offering taking weekly sales to 14 billion euros. In the US, high-grade bond sales also poised to miss estimates. UBS issuing the week's biggest deal so far, boosting volume above 16 billion. And the US junk bond market frozen following the slowest April in over a decade. The first week without any new issues since mid-February. Earlier on today, we caught up with BlackRock's Rick Reeder, making the case for investment-grade credit.
Some of the high-quality parts of the market, things like investment-grade credit, AAA asset backs, with yields moving up this much, you don't have to take a lot of what we call down the stack risk, equities, high yield, and you get some real yield in portfolios. So we've been starting to add there. Give me 2-year investment grade, 3-year investment grade, AAA securitized at 4.5%, 5.5%. Those assets are pretty good.
Still pretty cautious stuff from Rick Reeder a little bit earlier on. Hold your nose, cover your face, and dip a toe in and cross your fingers. Subadra Rajappa back with us, Tony Rodriguez and George Goncalves. Tony, Rick acknowledging how difficult this moment is. He's got a very big cash position still, but ultimately he's looked at the backup in yields and sees some opportunity within investment grade. Do you share some of those views?
Yeah, Jonathan, I share some of those views for sure. I mean, overall, we're advocating a very moderate risk posture and a very diversified exposure to risk assets. So we're not pounding the table that this is a major buying opportunity. We think spreads will widen here modestly over the next few months. But in terms of where to find that opportunity, I would agree with what Rick said about kind of high quality asset backed, short intermediate area. Those look attractive now. The all-in yields are attractive. I also think that in investment grade credit, once again, short intermediate makes sense. But even looking out to the high yield market, for example, the leveraged loan market, while we're very cautious about being down the stack or low in credit quality there, the higher quality segments of those markets have plenty of reasonably priced and attractively priced opportunities in our mind at this point, given the strong fundamentals supporting them.
Yeah, Tony, it's hard to say we've fully realised some of the pain of the credit market with spreads still pretty contained. I think we're all trying to understand what is keeping spreads so contained at the moment, Tony, given what's happening in the rates market, given what's been happening as well. with equities and this whole fear about the future. You talk about the fundamentals. People are gripped by fear that they won't be that great at the end of the year. Why are spreads still so well behaved?
So I'd say it's two things. One is that the market right now in credit is really still only priced for a kind of soft landing or very shallow short technical recession in that environment. And that is because the fundamentals are so strong. Looking at high yield is kind of the poster child for credit risk. Right now, defaults are running below 1.5%. Forecasts for 23 remain below 2%. This is versus historical averages of 3.5 to 4. So the fundamentals are strong, and that's because cash flow is strong, debt maturities have been pushed out, leverage has come down, debt service coverage ratios are attractive. So we're going into this Fed tightening cycle in really one of the strongest positions in a long, in numerous cycles from both a corporate credit standpoint and a consumer credit standpoint.
George, you give me the impression that you think there's more pain to come here. Why is that, and where will it be concentrated?
Look, so we've had a terrible Q1. Q2 hasn't started off that great. And the question is, where's the capital going to come from when there's still outflows? And, everyone talks about pensions having to rebalance. Like, there needs to be a new big base to replace the Fed. And the Fed is now making treasuries and mortgages much more attractive relative to all the other, credit products and throughout the fixed income world. So, if you're, again, I've said it before, they're breathing life back into these high quality liquid assets, it's going to come at the expense of other assets. And there's only so much balance sheet out there. And there's, unless there's a big kind of capital formation or distressed buyers show up into IG, I just don't think it's cheap enough. I mean, I think Rick's right in going down and hiding out in the 1 to 3 year part of the IG curve and high quality names makes a lot of sense, and staying very defensive in AAA and securitized products. But other than that, I think it's still the defensive mode is the way I would handle it.
Subadra, do you sense this is a whole new world that we haven't really got our hands around yet? George kind of nudged us in that direction about 10 minutes ago, that we've broken out into a new market regime, that the story of the last 10, 15 years, the last 40 years for the bond market was just ever lower yields, a central bank that was on top of the inflation story. Do we have to get used to high yields in the treasury market, not just for the next 6 months, but maybe through the rest of this cycle? We are in a new place.
It's really hard to know right now where things stand, that we're, actually going to shift into a new higher rate regime. I think that broadly speaking, I agree with what Tony was saying, as well as Rick had mentioned. For once in the last, decade or so, you're getting a decent amount of return to put your money back into fixed income. So, we've discussed ad nauseum on about like 60-40 portfolios not working anymore. If you are fully invested in equities, I think that this might be a time when, yields start to look very attractive in the bond market world, and you might want to sort of allocate away from risky assets into higher yielding bonds. Of course, there's risk associated with it. Credit spreads could continue to widen as the Fed raises rates. But I just don't see this yet as a sort of a credit crisis of sort. I mean, corporate profit margins are still pretty healthy. Yep. For the most part, balance sheets are strong. So, I think that this might be an opportunity to buy.
Subadra, to that point, most people come on the show and they talk about a Fed put that has been retired, buried, one that's not coming out anytime soon. Does that speak to that this Fed's not going to respond to what's happening with financial conditions just yet because you don't think there's a reason to?
Well, I think it's still too early in the cycle, right? The U.S. is not, facing, at least right now, I don't think the Fed expects for a meaningful slowdown in growth or a recession over the next 12 months. So their task at hand is to be singularly focused on inflation and to try to raise rates as quickly as possible. But say down the line, towards say September, you start seeing a meaningful slowdown in growth. I think that the way they look at the markets is going to become much more important. They're not going to be singularly focused on inflation. They are going to be concerned about employment as well as financial conditions. So right now, I think it's optimal for them to continue to raise rates. But towards the end of the year, they're going to have to do a rethink and see if that sort of current trend and pace of rate hikes is still appropriate going forward.
George, in 20 seconds, quick final word. Final word.
Look, all I know is that the Fed is basically defaulting on their third unofficial mandate, which is financial assets, right? I mean, they use financial assets, QE, to really engender a recovery in the last cycle. Focus on employment, have the binding problem of inflation being high, and I think this is just really challenging them in a way that they've never done in decades.
George, Tony, Subadra, sticking with us. Still ahead, the final spread, the week ahead. A busy, busy week with the big one coming up. CPI just around the corner. Live from New York City, I'm Jonathan Ferro. This is Bloomberg Real Yield. This week was a busy one. Next week gets even busier with a ton of Fed speak. Coming up, the final spread looks a little something like this. Plenty of Fed speak with Mester, Bostic, Williams, Barker and Daly all on the docket. We get CPI data out of China and Germany. Germany getting even more interesting with ECB official after ECB official talking up higher interest rates. Then the big one to watch is US CPI, another inflation print coming on Wednesday. And I've got the estimates so far in front of me. The median at the moment is 8.1 for headline. And just a flavour of a couple of names. B of A at 7.9. Barclays at 8.1, Credit Agricole at 8.2, HSBC also at 8.1. Let's get to the rapid fire round just quickly. 3 quick questions, 3 quick answers, and let's kick things off with this one right here. Have we seen the high for the 2-year yield this year? Have we seen the high, yes or no, Subadra?
No.
Tony?
No.
George?
No.
This is the one I've asked week after week. I'm going to keep asking it. Where does the Fed funds peak? With a 1, a 2, a 3 handle or higher? George?
2 handle.
Tony?
3.
Subadra?
3.
CPI next week. Where will we be year end? Pick a number, any number. George?
4.4.
Tony?
Core CPI 4.25.
Subadra?
Core PC about 4%.
So precise. Subadra Rajappa, Tony Rodriguez, George Goncalves, to the 3 of you, thank you so much. You enjoy your weekend from New York City. That does it for us. We'll see you same time, same place next week. This was Bloomberg Real Yield. This is Bloomberg TV.